Hi friends, in this video we will learn how to prepare a cash flow statement when 2 years balance sheet is given. So here we go. Balance sheet of ABC Company Limited is as follows. Balance sheet year 1, year 2. So here 2 years of balance sheet are given. This is year 1 balance sheet and year 2 balance sheet. So let us understand what are the various items that are appearing in the balance sheet. So machinery at year 1 is 800 and year 2 is 1500. Investments at year 1 is 13,000 and year 2 8,300. Cash is 200 and 500. Debtors are 10,000 and 15,000. Total assets are 24,000 and 25,300. On balance sheet liability side, share capital is 10,000 in year 1 and 10,000 in year 2. Retained earnings are 5,000 and 5,500. Creditors are 8,000 and 9,000. Bank loan is 1,800 in the year 2. So total assets is 24,000 in year 1 and total liabilities is 24,000 in year 1. And total assets in year 2 is 25,300 and year 2 total liabilities is also 25,300. Thus the difference between total assets and total liabilities is 0. That is our balance sheet tallies in both the years. Now to prepare cash flow statement, our first step is to take a difference between each and every item of the balance sheet. So balance sheet asset side machinery, year 2 is 1500 and year 1 is 800. So difference, that is B minus A, is 700. That is 1500 minus 800. Now thus there is an increase in asset of machinery results in the decrease in cash, and hence cash flow amount is minus 700. That is opposite of this 700. Second item is investment, which is 13,000 in year 1 and 8,300 in year 2. So B minus A is minus 4,700. The decrease in asset results in increase in cash, and hence 4,700 is cash flow amount. Cash year 1 is 200 and year 2 is 500. Difference is 300. Now cash not to consider here, we will consider is separately. So here it is dash. Debtors 10,000 in year 1 and 15,000 in year 2. So difference is 5,000. So increase in assets result in decrease in cash, and hence it is minus 5,000. So total of all these items is minus 1,000. Now let us consider balance sheet liability side. So share capital in year 1 is 10,000, year 2 is 10,000, difference is 0. So no change results in no impact on cash, and hence it is dash. Retained earnings 5,000 in year 1, 5,500 in year 2. So difference, that is B minus A, is 500. So increase in liability results in increase in cash to tally the balance sheet, and hence it is 500 in the cash flow amount. Creditors 8,000 in year 1, 9,000 in year 2. So B minus A is 1,000. So increase in liability results in increase in cash to tally the balance sheet, and hence it is 1,000 as a cash flow amount. Bank loan 1000 in year 1, 800 in year 2. So minus 200 is the difference. So decrease in liability results in decrease in cash to tally the balance sheet, and hence it is minus 200. The total of all these amounts is 1300. So net change, that is X plus Y, that is minus 1000 plus 1300 is 300. Year 1 cash balance as per balance sheet is 200. You can see here. Cash flow ending balance total of above 2 is 500. That is 300 plus 200 is 500. Year 2 cash balance as per balance sheet is 500. You can see here. Thus cash flow end balance matches with the year 2 balance sheet cash amount, and thus our cash flow tallies. Thus to conclude, what we can say is that for the preparation of cash flow statement, you have to compare two period balance sheet, and you have to understand basically how balance sheet tallies. If there is an increase in the asset other than the cash, then to tally the balance sheet you have to reduce the cash. Similarly, if there is an increase in the liability, then to tally the balance sheet you have to increase the cash. So once you understand how balance sheet tallies, you have to use same logic while preparation of the cash flow statement. Thus, if there is an increase in the assets other than the cash between the two balance sheet periods, like increase in debtors, increase in investments, increase in stock, then to tally the balance sheet, you have to reduce the cash. And hence, all these items are application of the funds and are recorded as a negative amount in the cash flow statement. Similarly, if there is a decrease in the stock, decrease in the investment, decrease in the inventory, that is the items on the balance sheet asset side other than the cash, then to tally the balance sheet, you have to increase the cash. And hence, all these items are recorded as a positive amount in the cash flow statement. Similarly, if there is an increase in the balance sheet liability side items between the two balance sheet periods, like increase in share capital, increase in bank loan, increase in bank overdraft, increase in trade payables, then to tally the balance sheet, you have to increase the cash. And hence, all these items are sources of the funds and are always recorded as a positive amount in the cash flow statement. Similarly, if there is a reduction in the balance sheet liability side between two balance sheet dates, that is reduction in the trade payable, reduction in the share capital, then reduction in the bank loan, then to tally the balance sheet, you have to reduce the cash. And hence, all these are application of the funds and are recorded as a negative amount in the cash flow statement. If you want to learn more about cash flow statement and more practical examples, my full-fledged course on cash flow statement is available on the Udemy platform. Link mentioned in the description.